Hey everybody, so I have a lot of tabs here and I'm going to talk about each one. None of this is financial advice. Please do your own research. Anything I've ever said, anything I will continue to say, and anything I say in this video is not to be viewed as financial advice. This is just my humble opinion. I'm constantly wrong and my views are constantly changing. I'm an idiot. I don't know what I'm talking about, so please, this is not financial advice. Please do your own research. This is just my humble opinion, okay? And a joke at best. I'm not a financial expert in any sense. So, in my opinion, the United States controls global liquidity to things like financial markets or global capital flows and interest rates. And a lot of times countries have to respond to this. And so, at the same time, China controls a lot of the production, like factories, exports, industrial capacity, and which is why the United States and China work together so well, hand in hand. With that being said, I think that the United States is currently in a position, based on the performance of precious metals and this business cycle, they're currently in a late bull market phase and and they could be heading towards an early bear market phase. And this right here, this chart isn't necessarily accurate and it won't be necessarily, but I think we can learn a lot just by observing this and getting a general idea of where we're going. And we can try to see if some of these things are true. I mean, precious metals like silver and gold are doing really well along with other commodities, while tech stocks, Bitcoin, the AI bubble, they've been doing pretty good, but a lot of the companies haven't been doing too well either. And a lot of the year-over-year growth in terms of their stock has sort of slowed down. And when you consider the devalue of the dollar losing value, then that's when you really start to see that the return on the investments year over year haven't been doing too well. So as we lower interest rates, as the dollar weakens versus other currencies, the return on the investments total of the tech stocks and the AI bubble haven't been doing too well. So even though silver is doing well and gold's doing well, Bitcoin, I think Oracle, maybe Palantir, and a few other, Meta, for example, and a few other companies in the AI bubble haven't been doing too well. But I think it's also important to consider that because China and the United States have different types of systems, economic and social systems, like the United States uses their stock market and asset bubbles as sort of like a welfare system or like a universal basic income, while China has more of their own sort of like pension program through the government, or maybe they don't rely on asset bubbles. They used to rely on the real estate bubble for the wealth effect, but they're trying to transition away from the real estate bubble into more stocks, and real investments and things like that. So you're seeing that there's two different economies with two different systems, which means that they develop differently, and like how their stocks will react and their asset prices will react will be completely different. The United States might have to backstop and help their assets stay high, or help their, in order to help their pension funds and their retirement funds and 401k stay up, and people have the wealth effect created, while China can create the wealth effect through other means. And when in the United States, for example, when people retire, they rely on their pensions, 401ks, which is comprised of stock, bonds, and assets and things like that. While China, they could be moving more towards that, but they also have their own system as well. Like where there's generational households, the kids will take care of the parents. There probably is some stock, bonds, and assets that they use, but a lot of it's not as heavily dominant as it is the United States. So having asset bubbles isn't as encouraged. And if these kind of asset bubbles create more wealth effect, then it's not beneficial. So the business cycle and stock market cycle in China and the United States I think they're very different. Just because the United States is going through like a technology bull market doesn't mean that Chinese stocks will reflect that. Like the Chinese economy might also be going through a bull market in technology and industries and utilities, or precious metals and things like that, and some of them interlap, but the stock market might not reflect that necessarily. And again, the way the stock market works in the United States and in China is a little different because of the purposes behind them. So, for example, when in the year 2000, when we had the dot-com bubble in the United States, China joined the WTO, and I think that helped a lot because China could sell us United States a lot of goods and services for cheap, which was deflationary for the United States economy, and they could buy a lot of our debt, which means the government could do more spending and things like that. And in 2008, when we had the dot-com bubble, again, China bailed out the United States in a lot of ways by allowing the United States to print more money, introduce quantitative easing. China exported a lot of their deflation to the United States, and this just gave a lot of the room for the government and the Fed to use a lot of different monetary policies in order to help fight inflation and revitalize the economy. So I think we're currently in that phase right now, and I'll be going into that a little bit more. So yeah, looking at this economic cycle, I think we might be in the late bull market in the United States, based on precious metal performances. And I thought it was really interesting because currently the Nipah virus is popping off in India, but this might amount to nothing at the end of the day, based on how the Nipah virus works and its high mortality rate and things like that. But I thought it was interesting that Moderna and a lot of bio stocks, which could benefit after the precious metal phase, a lot of the stock values have been beaten down. But it was interesting because 3 weeks ago I bought some call options on some of these bio stocks and pharma stocks, and again, not financial, it's just my opinion, but I noticed that the mRNA 1215 vaccine, I believe, which is from Moderna, was made in response to the Nipah virus, and at the same time the Magna Carta was in 1215. So if I think that we could be going through a bear market soon in the United States and we could be peaking the economy, I think with how the global developments will occur over time, it might be better to have, I'm not saying it's ethical, but the government may want to use another lockdown like we saw in 2020, and it allows for more efficiency, it allows for more stability. If the state is trying to consolidate power, if the government wants to minimize variables like small businesses and consolidate them, and create more market efficiencies in the financial markets, in the business markets as well. It's easier to manage the capital flows and handle volatility if you have fewer large companies versus a bunch of small companies. So small businesses have replaced, of course, one of our largest employers in the United States, but if we want to see a consolidation of the businesses and public and private sector, then another lockdown, as we maybe lower tariffs in the long run or soon, along with lowering interest rates to help us refinance our debts, may be an option. You could have something like the '08 crash, but I don't know if you'd really want that right now. So yeah, I thought the Nipah virus was very interesting. It may amount to nothing, but the United States should try to deflate the AI bubble a little bit, but keep its purpose as a welfare program or a UBI for Americans, while also maybe using some of that capital and moving it into pharmaceuticals in the United States and other other sectors that haven't been doing too well, where you can see more value, which could help the real economy as well, and have some capital flow move into Asia, to soak up the inflation that having more money into the economy could create. So if we're going to be lowering interest rates and we want to remove some of the concentration from the AI bubble, then I think that we could be seeing some money move into pharmaceuticals and bio stocks, and into emerging markets in China. I mean, if I were a firm, this is what I would do. And well, I don't know if I do well, but that is what I would do. So I think one of the most amazing things that we've seen over time as people invest in China is that a lot of Chinese companies that maybe could have been positioned or are positioning to open up into Western markets and form joint ventures or sell their vehicles and their exports are becoming profitable not despite international markets and international demand going down. So companies like companies like Neo Technologies, they're either nearing profitability or becoming profitable by some means, despite the demand internationally going down. And this is, a lot of it has to do with like encouragement from the government, but a lot of it also has to do with just these companies becoming more efficient over time. So I think that currently with Chinese stocks, even though they serve a different purpose in their respective economies, the stocks themselves, from like a standard valuation metric, has a lot of positive prospects. Especially, I don't think it's necessarily calculated or reflected in their current stock value. That's just my opinion, though. So, if you're a firm, right, and you're trying to look for a place of where to invest your capital, I mean, the United States currently has an average PE of 27.16. Canada has 20.74, and these two markets are pretty developed. So there's like the the laws are pretty stable somewhat. The financial markets are pretty stable as well. Same thing if like the EU. Looks like their averages are anywhere from like 20 to 18 on average. And yeah, their PE ratios are still kind of high, but not as high as the United States. And they do have developed markets along with deeper financial markets and political stability as well, to some extent, sort of. But yeah, I mean, the PE is still pretty high. And so when you look at places like China, where the means of productions actually exist, where their capital markets are huge and the financial markets are pretty developed as well, and there's a lot more political and economic stability as well, that's another place that could attract a lot of foreign capital, especially despite capital controls, the low PE ratios. And even if there is some risk, there's risk for every country, even the United States. Like, the PE ratio in the United States might be high, and they might offer some stability in some sense, but like every country has their own game that you have to understand. So I don't really think that it matters too much. But if I were a firm and I were chasing like higher return on investments just from like a standard stock valuation model like PE ratios, then I would consider China, because they're currently, based on PE ratios by country, is 11.8. Japan might have been another good option, but yeah, they're currently at 17.36, and we're gonna have to see how things unfold there. But yeah, just even for me personally, if I were to invest in China, that doesn't mean I don't invest in the United States. I invest in like medium caps and smaller market cap companies, along with some pharmaceutical and bio stocks, for example, where I see there could be like a rotation into. I don't know if I really want to use this yet. But yeah, looking at the 10-year here, eventually you're going to want these to come down. So it made me wonder if the United States may want to create some kind of crash. I mean, you can have the Federal Reserve lower interest rates if maybe you lower tariffs if you want to reduce inflation. But yeah, I mean, I don't want to get too political in this video, so maybe that's for a different one. But yeah, the United States may want to lower its tenure and their yields on their bonds, because it makes it much more expensive to refinance their debts or roll them over. So I'll skip that. I don't think that's too important. Yeah, I don't know why I had some of these open, but based on this right here, we have a lot of the energy that China's been using. It's generally been rising despite tariffs, despite trade barriers going on by the United States and European Union and those Western allies. Energy consumption by China has grown substantially, so that can be a more honest indicator of what's going on. Also, with China, they're offshoring a lot of their manufacturing and supply chains, so when it comes to GDP or trade data, not all of that might be factored in. So China's total exports, when you consider what's offshored, may be much larger than this. But it's also important to consider that I guess I didn't have too much structure on this thing. So I guess I'll skip this. I think this was very interesting because eventually, the China wants to move away from, or not move away, but diversify its economy, right? They want to export into other countries, and Africa is somewhere that could really benefit from the green economies, for example, like solar, electric vehicles, and things like that. So in the long run, we could see that China moves way more towards Africa to help with their exports and just global developments in general. We're going to see more of a focus on Africa and maybe the Middle East and things like that. But this has nothing really to say. I know I want to talk about it, but I don't think I will in this video. And I think when it comes to understanding China and why their stock market may not be doing as well as the United States in terms of like the return on investment, is because China may be they might dominate in a lot of areas. They could probably dominate in the financial markets as well if they really wanted to. They could probably dominate in numerous ways, like from global financial markets, exports, high technologies, high grade goods, things like that. It could be a mixture of their population, their structural foundations that they're built upon. One is built on agrarian society, one is built on imperialism, which one country just like China may just look more attractive in terms of like investments or partnerships. But I think it's really important to consider that I remember watching the WEF recently, the World Economic Forum in Davos, I think in 2026, and it's really hard to financialize your markets the way that United States does, because the wealth inequality in the United States is vast, but the wealth inequality in China is very vast too. And it's very apparent here when we look at this. I mean, the PPP GDP per capita in the United States, I mean, in China, there's a lot of wealth inequality. You have some places where they're averaging 30,000 and 50,000, but you have some places out here where it's like much less. And in the more developed areas where the high incomes are much higher, more of the younger folk move into these urbanized areas, and in the rural areas, which is much less of the population, I think it's like less than 10% of the population, which is still a lot, right? Out of 1.3 billion people or 1.4 billion people, this large area of China right here, the east side, while it is more rural and less developed, and there is much less of the population here, and generally the older people live in the rural areas while the younger people move into urban areas, the wealth inequality is still very high. And if you have asset bubbles like in the United States, where you have like Palantir having like a P ratio of anywhere from 300 to 500, and Nvidia and Tesla and all these other kind of companies, then the wealth inequality would be very high, which leads towards more economic instability and more social instability and more wealth inequality. So, things like capital controls and why the stock market and asset bubbles move a certain way. Why Xi Jinping said that homes are for living in, not for speculation. These types of managing of their asset bubbles, yeah, they have negative effects when it comes to investors in China like us, but at the same time, you have to understand the game that China's in, and that doesn't mean we won't see higher stock values. I do think we're going to see that very soon, actually, maybe 2026 or 2027, depending on the business cycle that China is in. And I think they're currently in one of the later phases before like a new bull market. But yeah, the wealth inequality in China is still there. So you can't, if everybody owns a phone and everybody's financialized and everybody owns some kind of brokerage in China, I'm not saying they do, but if they did, yeah, you can't have stock market bubbles. I mean, I already saw some of that in Vietnam, and it's pretty crazy. So this is the GDP per capita. Here is a better, more numbers here. As you can see, some areas, some provinces have higher GDP but per capita, but other places don't. And you're not gonna want again, the stock market bubbles and real estate market bubbles. I mean, certain bubbles have their places, right? And when you're having bubbles and things like real estate, so you can speed up urbanization, then it makes sense. But eventually it pops or it deflates. You're gonna want capital and investments to flow into electric vehicles, or solar panels at one point. But eventually these things have to deflate because they're not good for the economy and society if you have too much wealth inequality from asset bubbles. And again, stock markets in China don't serve the same purpose as like a welfare system or a UBI that they do in the United States. And even looking at the demographics here in China, when the older demographics die off, which I believe live in more of the rural areas, it could free up some resources. When you have China moving more into like artificial intelligence and robotics, it can really help a lot with a lot of the rural areas that make up in things like agricultural exports and maybe some sort of like textiles and things like that. So I know that the demographic issue is a thing, but it really depends on how you view it and the context behind it. So it may not be as bad as the United States depending on how you look at it and how the country is handling it. But that doesn't really matter. I mean, even with the United States, the demographic, there are issues here too, and that forces a lot of immigration, which is, I'm not saying it's good or bad, but it is what it is. And it does have its pros and cons. And if you want to perpetuate asset bubbles, okay, yeah, that's good. If you want to have like a pyramid system, yeah, that's good too, but it's just different. So this is the same thing. Chinese property sector. Yeah, so I was just looking at some solar companies as well. I mean, you're going to want a lot of investments into these kind of green technologies, but ever since then they haven't been doing too well. Skip this. But yeah, again, like countries that could really benefit from it are on the Belt and Road Initiative. So now, as we can see here, the Chinese yuan has been strengthening versus the dollar. And as we this can be good for companies like Alibaba or Neo or Niu or Tencent, where they probably have most of their capital in Chinese yuan or RMB. And so if the Chinese RMB and their assets on their if their financials and their if their capital that they own is denominated in Chinese yuan or RMB, when the RMB strengthens versus other currencies or versus the dollar, it makes the company's financials look much stronger. So if the RMB appreciates versus other currencies, then it gives the opportunity for arbitrage on China's side. So if companies like NEO wanted to buy commodities and raw materials and raw goods, they want to make acquisitions, they wanted to make investments, they wanted to do these types of things, or buy United States denominated debt or United States treasuries, things like that. They can buy at a more favorable vantage point, and these things will make their financial statements or balance sheets look much stronger. So when you have companies like NEO, where they mostly have their cash in RMB, then it makes their cash position look much stronger, especially as the yuan strengthens versus things like the dollar. And again, it makes things like raw materials much more affordable. All these things add up, and it can help on the bottom line. So maybe we'll see the same thing here in 2020. When the markets crashed, we saw the Chinese stock do very well, and this is because the yuan strengthened heavily versus the dollar at this point in time. Before, I believe, the Fed started raising interest rates. So we could see an opportunity again where maybe Chinese stocks can do well in response to a strengthening yuan. So even though China is offshoring a lot of its manufacturing, it doesn't matter. I mean, you have these crashes here in 2008 and 2020, but the PMI stayed pretty strong despite offshoring and things like that, and nearshoring. So let's see. I think this is also really important when we want to understand China, where they're coming from. So a glimpse of China in 2035. These are things that they want to focus on. They want to raise their GDP per capita. And, you can do this by raising government spending, maybe raising their exports, things like that, increasing manufacturing and exports, and just finance. You can do this in numerous ways, but, I think we're going to see a lot of we're going to see a lot of positive headwinds that can promote higher GDPs. And currently with innovations, they're doing really well. Let's see, better lives, higher standard of health, sports excellence, thriving culture, higher caliber workforce, first class education, laws-based country, government, society. That could be good for people who want more rules within the financial system that they can work around as well. But more importantly here, with the federal interest rates, will we see them drop? Well, at this current moment, the United States interest on their debt, on their national debt, is becoming very expensive. I think it's like anywhere from like 1.7 trillion to 2 trillion. That's a lot of money. So what the United States could do is that, this is my speculation, but I think that China and the emerging markets in the global economy want the United States to have lower rates because it increases global liquidity. This makes it so global production goes up, more people can pay off their US denominated debts at a lower cost as well, and including the United States as well. I think that currently we see that with higher rates, it's a real strain on global production and global manufacturing and things like that. And yes, there are certain people in the United States who benefit, such as savers or money markets. They benefit from it, but the government doesn't benefit from it. Businesses don't benefit from it either. And we can probably open up a lot of liquidity if we lower rates down heavily. So rather than moving into money markets, they'll move into probably stocks. Actually, I think they could be moving a lot of their money from these areas into foreign investments, parts of the economy we haven't been doing so well. United States companies as well that like they're small caps and medium caps that haven't been benefiting from high interest rates or lower interest rates. And but I would wonder if, because the United States has to keep their asset bubbles up, if rather than pop the AI bubble like everyone's speculating, that we could slowly deflate the AI bubble, or have the return on investment of the AI bubble slow down, the return on investments on the AI bubble slow down, but move into other parts, like bio and pharmaceuticals and things like that. So when we look at this thing here, there's a lot of reasons why precious metal is doing well. It can be because of like demand, constrained supplies because of like China's retaliatory tariffs, or their restriction on rare earth metals, or they own the means of production and refineries, so maybe the supply of silver is being artificially controlled. And we've seen that throughout history with China as well, though. They'll restrict their rare earth metals like they've done during the Japan Circa or something, and it's not like they haven't done this before. So they have before. So we could be seeing a top here where the AI bubble is slowing down, and rather than pop it, which would create like a huge crisis in the America and the global economy, the most stable thing to do is to either deflate the AI bubble slowly, or have the return on investment of the AI bubble slow down, and promote and encourage capital to move from the AI bubble and tech stocks into things like precious metals, to take up some of the inflation, and also move some of these things into more of the real economy stocks, bio pharmaceuticals, healthcare, things like that, and also the global markets as well, like China and the emerging markets, especially when you consider how low the PE ratios are of the Chinese stocks. So let's see this one, global liquidity. I don't know why I had these open. I think I want to talk about where I could see Chinese investments in the long run, and how I could see global developments playing on the long run, considering Africa's increasing population while everywhere else seems to be shrinking for the most part. But I don't think I'm going to talk about that in this video. But it all goes hand in hand. But if we consider the rising unemployment in the United States, just by this quick graph right here, if we are currently in a position where we have to go through some kind of deleveraging in the United States economy, and we need to go through some kind of bear market cycle, we may want to do that in a controlled environment. And so again, if you have like a dot-com bubble or a 2008 financial crisis, these things are very they promote a lot of instability. They can be very dangerous, and it becomes harder and harder to control your economy and society. The more leveraged you are, the more complex things become as well. And the United States has more tools than ever to handle and promote stability. And you don't have to agree with like the ethics behind it, but I think, I don't mean to be like I don't mean to say anything that's offensive, but I think that if I were a world leader, and if I didn't have ethics, morals, then the United States may want to have another 2020 type lockdown, where society can be controlled much easier, the economy becomes more efficient, consolidation to the state increases, and consolidation of the banks, the financial systems, businesses, all these types of industries, they become consolidated, which creates more efficiency, especially if you're trying to, in the long run, promote more capital flows and foreign direct investments. I mean, you want, from like a financial point of view, you want your economy and society to be more attractive for an investment. So again, having less spaces of gray area, having less areas where people can hide their financial transactions, having areas where people can, there's less bankruptcies, less debt delinquencies. Yeah, you may want to make your economy more attractive towards investors by, again, like consolidating some businesses, some banks, some financial industry, the different sectors as well. And you can have that while increasing your laws and rules by doing these types of things, while also increasing the police state, like ICE, for example, or your police force or your military force. And if you have a lockdown, it's much easier to have efficient societal and economic movements as you're reforming and, reforming your economy and society to become more attractive and more manageable in its reform. Because the United States is on a not unsustainable, but it's in a path where, it benefited a lot from 1942 after World War II, but at the same time, a lot of the world is developing, right? Like, you have China moving from third to second into second to first. You have Vietnam moving from third to second. You have a lot of Latin America and South America moving from like third to second, and some of them are moving to first. I mean, even China has some areas where they're moving into the first world economy. And you need to position your country by things like devaluing your currency and sharing and creating more joint ventures and deleveraging and making your economy more efficient to handle the structure of the new world. And so maybe I have a global... Let's see, maybe this one. I'm not saying it's right or wrong, but again, eventually Africa is going to be moving up from third world to second and first. And so China, not everywhere, is going from like second to first, but Beijing, Shanghai, Chongqing, like these places are all moving up from like third to second, maybe first-ish between there, and some places are first. And so they do become more competitive in things that first world countries have been very dominant in, like automobiles, AI, robotics. And we saw the same things with, like, I don't think it was the robber barons, but the United States at one point wanted, a long time ago, they want to consolidate their oil companies, and they're all broken apart. And that could have perpetuated the U.S. dominance. But yeah, so as other countries grow, you need to fit those countries in within the global economy. And the United States cannot become isolationist because they don't necessarily own the means of production. They have a lot of debt that they have to pay back, and they're just not structurally set up to be that way, where it'd be efficient. And everyone benefits. I mean, if the United States did decide to go isolationist, then the world would just develop an entire economy away from the United States, which wouldn't be good for the United States. So yeah, as countries start developing, India moves from third to second, more towards second. A lot of parts of China go from third to second, and some parts of China go from second to first. You need to be able to soak up that population moving in to a more developing global economy and society. So yeah, so with that being said, as the United States makes the reformations, like many Western countries have been doing over long periods of time, for centuries, and you can't beat down this country and then like bomb their people into third world. You just can't do it. Like, it's just not going to work. Maybe at one point countries did that, but you can't do that with a place like China or India. or Africa. Well, maybe if Africa you can a little bit, but it's not as easy anymore. Western powers can't do that anymore. I think that we've seen phases within China where they go from like overbuilding, overcapacity, where China's like aggressively expanding in certain things. Like in 2013-ish, we saw China move a lot of their investments into real estate, and so that allowed for China to promote faster urbanization. It did create things like ghost cities, and it did grow a lot of debt. But it also allowed for Chinese people to move into urbanized areas from rural areas, bringing up their poverty and lowering down their poverty as well at really rapid rates. And if you can lower down real estate prices while slowly managing their financial markets as demographics change over time, and their industries change over time, so that they can financialize more, and that they can maybe use stocks and maybe buy bonds and things like that, then you can have Chinese in a position where they can start maybe having a balanced portfolio of their savings, rather than rely on the wealth effect from their home values and things like that. So you can have faster urbanization and lower poverty rates at a rapid rate, and you can move money away from the real estate sector into stocks where there's more productive capital. And we saw that again in the early 2013s, 14s, 15s, and then we saw that over time. Xi Jinping, I think it was in 2017 or 2018, said that homes are not for speculating, they are for living in. And that's when we saw the policy shift in China, where Beijing and China really tried to change this, and they Evergrande, real estate bubbles started to pop and deflate. And now what I've noticed currently is that real estate value is going down in China, but that makes it more affordable for youth, and that makes it more affordable for people to live in these more urbanized areas. And at the same time, while it does create the wealth, it does hurt the wealth effect. It actually opens up a lot of spending as well, in my opinion, because money will move from real estate into stock markets globally, preferably in China, but global stock markets. They'll move into maybe like bonds, for example, as well. They'll spend more on domestic consumption, which is what's currently going on as well with the government support. And they might spend more on the real economy. And it basically, after that, you want to stop the asset bubble. And then currently right now what we see going on is that the Chinese, despite popping their real estate bubble, what I've seen is that it almost seemed as if like Evergrande maybe might have bottomed. So this could be a better reflection of, this could be a reflection of the overall sentiment within the real estate sector in China, where, well, I guess I can't find it, but maybe the real estate sector in China could be bottoming, and despite the asset bubbles popping in China with real estate, the government is bailing them out. It's not as popularly discussed, but the government did intervene to make sure that these companies stay relevant and that they're still working. And this also, in the long run, after global liquidity increases, it gives the government more resources to invest into other areas like electric vehicles, batteries, solar, infrastructure, the grid, and things like that. So, I currently think that we're in a phase where maybe China is actually near their bottom, early bull market. And we saw NIO, for example. We saw NEO, for example, bottom around $3 and something 50 cents ish, something like that. And same thing with Alibaba and the Hang Seng. The Hang Seng, Alibaba bottomed around 70 or 80 or 60 from what I remember, and the Hang Seng bottomed anywhere from like 14,000. But they've pretty much doubled since then, and that could have been the bottom right there. So maybe it's possible that we are in an early bull market phase where capital will flow into the large caps and then trickle down into more speculative, more risky assets that aren't yet profitable. But again, the most amazing thing to me is that Chinese companies, if we go through the same thing like 2020, where we see a bull market in Chinese stocks, and Chinese stocks have been doing really well when you consider like the Shanghai index, the Shanghai index, I forgot the other one. Sorry, it's been a long day. The Hang Seng, things like that. They've already performed really well since their bottom, so they could be in an early bull market phase. And when the United States cuts interest rates, whether it be because of black swan event or gradually over time, if they can do it right, then you could see a large bull run in Chinese companies that are much better than in 2020. Maybe, I could be wrong, and I kind of doubt it, but it would be great if it did happen. But again, if we are currently in early phases of 5, and we're between 4 and 5, then companies like NEO are in much better positions now. They're closer towards profitability. Some of these companies that were more speculative on the brink of bankruptcy are actually profitable now, or very close to profitability, despite trade barriers and tariffs. So if the United States wants to benefit from best of both worlds, so they have like low interest rates along with low tariffs to help with inflation from low interest rates, and benefit from global production going up and global liquidity going up, and still having like a very attractive financial market, and still dominating in its role as a distributor of financial assets and dollar denominated trade, then what they might want to do is they might want to go through a situation where after their expansion and after their late phase bubble, they might want to have an area where they reset. And we saw that during the 2020 lockdowns, but they might want to consider doing something like that again. I mean, again, if you're just considering efficiency economically, then you may want to crash your economy, make your economy and society more efficient by consolidating and controlling your economy and society through lockdown. Promote your pharmaceutical stops by having a similar lockdown, and then lower tariffs as well as interest rates lower first, and there's lockdowns. Slowly open up your economy, and then also reduce tariffs as well, and have a mix where you open up your economy as tariffs are reduced to form joint ventures to promote more job growth as tariffs lower in your service industries and your joint ventures and things like that. And there's a balancing between the two, but yeah, you may want to find where that is if you're the United States. And you can position yourself in the United States to benefit from lower interest rates and larger global growth if done properly. So I think I'll make a more coherent video. I've been really tired, I've been very busy, and honestly, as someone who invested in silver around $16, I've been having a lot of other things in my mind. But yeah, it makes me wonder, will we see another type 2020 type scenario again?